So on today's episode, we're going to be covering cash conversion cycles, a North Star metric of your supply chain and operations, how to leverage finance to improve the metric and scale fast, and the channels you should be focusing on to beat the financial odds this year. Hello 2Xers and welcome to the 2X e-commerce podcast. On today's episode, I'm joined by Peter Beckman. He's a co-founder and CEO of Treyd. It's a Nordics Fintech startup that provides supplier financing to e-commerce businesses with international supply chains. Treyd supplier financing solution enables UK and Nordic-based businesses actually pay their suppliers in advance, which solves a major problem faced by many businesses that sell products but struggle to purchase enough inventory due to cash flow constraints. So why should you listen to this episode? Well, Peter shares valuable insights to understanding cash conversion cycles. He breaks down the concept of cash conversion cycles, shares practical tips, and tells us why it's important for e-commerce businesses to optimize for this metric. Secondly, Peter shares supply chain and logistics insights and updates on the current state of the global supply chain and how it affects businesses right now. He also shares data Treyd is seeing from its most operationally agile client base. Finally, Peter shares multi-channel strategies from some of Treyd's best-in-class, fast-growing e-commerce businesses that are defying the current economic odds. He explains the channel mix and the channel you should be doubling down on right now if you haven't already. So without further ado, let's get started. Hey, Peter, welcome to the 2X e-commerce podcast.
Hey, super fun to be here. I'm a fan.
Brilliant. You're a fan. We're also a fan because we use your service and it's been a growth tool, a growth secret at Octillion, right? So super excited to have you and thank you for actually accepting this interview.
Yeah, and nothing makes me more happy than hearing from happy customers. That is why we built the company, to be the secret sort of growth source for really cool, fast-growing consumer brands.
Yeah, amazing. So Treyd. So you're spelled Treyd, right? But you're pronounced Treyd. So I'm going to take it
Correct.
Treyd. You're based out in Sweden. You serve the Nordics and the UK. I've actually had conversations with guests from the US and I mentioned Treyd. I'm like, okay, I actually goofed because we had another sort of business that does similar to what you guys do, who are based out in North America and they serve, North America. So you're predominantly the UK, the Nordics, and I believe you're going to be expanding further into the States at some point.
We will. So second half this year, we should be in the US. And we'll continue to expand within Europe as well. We think adding like 4 or 5 countries per year is kind of a good rate for us. So that's the tempo we're setting for ourselves. And the UK we started in Sweden for the very simple reason that that's where we were. And it's a very good place to start a fintech. But we always thought that the next big bet needs to be the UK. It is a big international market, and we always thought that this thing we're building is something that's needed everywhere. So we need to go to the real world, let's say, the big world, and that's been super fun.
Interesting. We'll jump into that. Speaking of which, back in 2016 or 17 on this show, we had one of the founders of Klarna come on. Again, from the Nordics. And at the time, they were just getting into the UK. Yeah. And I didn't know. I was like, okay, wow, okay, right? I'm having the founder and, tell me a bit about you. Tell me what you do. Your buy now, save later sounds interesting. Yeah. However, they became a household name. It's become a verb, essentially, with millennials and Gen Xers. Gen Zers, rather.
It's a super fun story, I think. And obviously, Stockholm is not that big a place. So I have a lot of friends who were there already in the early days. And they're kind of the sun in the solar system here, I think, in the fintech world in Stockholm. So it's really cool and inspirational.
Okay. So, Peter, let's find out a bit about you. Just a background. I want to know who you are as a child. What's that trajectory? I want to get your backstory as far back as you want to share. On here, we would like to hear what kind of where you grew up. Where you schooled, and your formative years essentially.
Yeah, it's not entirely obvious. It wasn't obvious for me, at least, looking back even because I grew up on a farm in southwest Sweden. So, well, at least I learned to work hard because that's what you do
On the
on
farm.
farms. And I thought actually I was going into the military, and I spent a couple of years there. But when they were like reducing the budgets, I realized like, okay, there is no future in the military, at least in the next coming years. I was like, I need to study, and I was always interested in business and entrepreneurship, even as a kid, and like ideas mainly. So yeah, business school. And for someone who was, the classical guy at the back of the class who didn't really love going to school, rather the opposite, I ended up doing a PhD in corporate strategy in Switzerland, in St. Gallen. So one of the very good business schools in Europe, which was, I don't know. I guess I will never forgive myself. That's a weird thing for someone who hated school. Based on that, I got into strategy consulting. I primarily helped large corporates do business in high-risk geographies. So a lot of business in emerging and developing countries. A lot of those sort of challenging, complex situations, cross-border finance, cross-border strategy. But for larger corporates. And at last, I sort of decided to properly try the entrepreneurial sort of path that I always, as a kid, thought that's what I should do. And started a company with actually a colleague from the PhD times, an American. So we built a startup that did geographically based risk analysis. So we basically analyzed all the newspaper articles in the world, satellite data, etc., to understand sort of called cross-border risk in real time on a global scale. It did have technically we got off to a really good start, and we thought this is going to be a base for cross-border finance. But I also had some stupid hobbies. So I was doing a bit of extreme sports. I was doing what's called speed riding and speed flying. Okay. And on one of those trips, I managed to fly myself into a nice Norwegian mountain and broke a lot of bones, a lot of them. So, well, simply put, I had to spend 6 months in a wheelchair, a bunch of surgery and that kind of crap. And that's not the place to run a startup, especially sort of that's based on the other side of the Atlantic. So that we stopped that project. What was good in the end is like it actually turned into multiple new companies that were even better, and Treyd is one of them. Because sorry if this is too long, but
no, go for it. No, we have to.
I had fun timing. Roughly when I was allowed to walk again or could walk again, I get a call from Antler, which is an accelerator program. Who asked if I was interested in joining their next cohort in Stockholm. And I thought, perfect, let's go for it again, do it, try again, try it better. And this time, let's build the financing service for companies who trade internationally rather than sort of build a data company to sell to large banks and insurers because they're never going to build that service. That's one of the realizations. But to really then to nail down, it's like I mean I've spent like my adult life, which I guess the years are sort of adding up now, in cross-border finance and cross-border business. And there's so many problems, especially for small, young, fast-growing companies have enormous challenges in cross-border, especially on the financing side. So we became, I met my co-founder in Antler, and we decided to really nail down by talking to lots of smaller companies who did international trade to really figure out like what is the biggest challenge you face. And it was actually quite quick because company after company were saying exactly the same thing. They're like, if you can solve our import problem, we'll be your customer. We're like, okay, so what's your import problem? We pay our suppliers in advance, and there's just no way to fund that. And that means like we're constantly out of stock for our most important product. So we're like wasting our marketing dollars. We have the customers, we just can't buy enough stuff. And they do things like they do air freight just to get the stuff faster from factories. Often, like if you're buying from China, which, as you know, a lot of brands are, it takes a week instead of 6 to 8 weeks. So that means you can buy a little more inventory because you bind less cash in your supply chain. But it's super painful when you have built, created a product, built a brand, you get the customers, but you just can't, you don't have stuff to sell to them. It's a ridiculous problem, fundamentally. Those brands have solved the biggest problem. So we thought this is the problem to solve. And what we had an indication of that, we talked to, I don't know how many, but quite a few brands that said exactly the same thing. And when we also sort of lifted the gaze to analyze the word, how big of a problem is this? We realized that almost 30% of world trade is paid with cash in advance. So we also realized this is a global problem that affects hundreds of thousands of brands around the world. If we can solve this, we can build something meaningful, a meaningful company that really solves one of those big unsolved problems in the world. So yeah, that's how we got started.
And then I'm going to go back to because it was quite a marathon on that one. My first thing I picked up from what you just said is your work ethic, which you got from the farm, and you thought you'd transition it over to the military. Now, with that, you couldn't, just due to budget restrictions, and then you got into business, and that took you to the highest echelon, really, which is a PhD in Switzerland, University of St. Gallen, I think.
Yeah.
With the accident, you had to sort of transition. You also have that corporate strategy background with cross-border experience. And with that, you had to transition to you were offered, you got into Antler, which is kind of like a Y Combinator, accelerator, really, for Nordic companies, I believe, or Nordic startups.
It's actually globally. So they're in
it's global, okay.
UK, US, Asia, Africa, everywhere nowadays.
Amazing. Okay, interesting. And so how long was it incubated for at Antler in terms of Treyd? How long did you really, really iron out that 30%, which is a huge number? 30% of all global trade is paid upfront, pro forma invoices. So how long was it incubated for?
So
when did it go to market?
It was actually in time a really short period. It was roughly 4 months in the accelerator, and 4 months is really nothing. In a startup, it's a long time. So I guess it's how you wanna think about it. But essentially, we came out of there with a little bit of cash and a very a fairly honed out but still rough idea and the PowerPoint presentation. That's the summary of it. So then the journey really started. Then we're like 2 founders in a sort of co-working space in Stockholm, getting going.
What's your co-founder's name, and what is he or her background?
Yeah, so his name is Same El Ansari. So he's an amazing guy. He did his PhD in Stockholm, but in computer science back in the days, and then he was a co-founder of Hive Streaming, which became one of 2 world leaders in sort of corporate video streaming back in the peer-to-peer days. He was then involved in, or co-founder of RaceFox, which was one of the first real AI for sports companies. And then he got into fintech and crypto for a couple of years, and he had a slightly different idea related to sort of crypto and payments that he came to Antler with, and we met in the accelerator and really found that kind of perfect match. And it felt like his tech and the problem I wanted to solve was this is a excellent match. And of course also that mutual respect and being different enough to make a good team and similar enough in other aspects. So that was enormously fortunate. And also having a partner that is an experienced entrepreneur is, I mean, it's incredible that because you go through a lot together, and you know, someone who's been through it before, has seen the sort of movie play out before. That's quite valuable.
Yeah, amazing. It's so great to have a Wozniak and Jobs combo to really scale up a business, and that's what I see you have. So Sama is more a CTO, you're more a CEO, looking
Exactly.
at the dynamics of the market and actually paving the way and saying this is where we need to go, and then he just executes from that standard, from that point of view, from a technical standpoint.
Exactly.
Interesting.
And it's very simple, right? Building a tech startup is like someone needs to build it and someone needs to sell it. That's what you need. And I think so. It's a very natural sort of combo.
Yeah. Speaking of Swedish startups again in the fintech space, there's also Uni. The online. They don't call themselves an online bank for e-commerce, but they're an online bank for.
They kind of are.
Yeah, they are. Exactly. Okay, so your value proposition at Treyd, would you say your invoice financing, or would you say your supplier financing? Just want to get the verbiage right.
We'd rather say supplier financing, or sell first, pay suppliers later. A lot of words, but it really explains what we do. And the reason we're not invoice finance, because usually invoice finance to most people means that like factoring, you have sold something and wait to get paid from your customer. That's the normal sort of invoice finance. What we solve is a different problem. It's when you pay your suppliers before you get the goods. And that has been an unsolved problem in the world until, fairly recently. So that's why we honestly struggle a little bit with the term, because like whatever you say, people think of something else. At some point we just said, buy now, pay later for world trade. And then we realized, well, that's actually a checkout solution that people start thinking about. We're absolutely not the checkout solution. We're, credit payments for supplier payments. That's so.
Yeah.
Sorry for the many words, but it's
No, I think the hook is something people are already used to. So we had a founder of Occur Savings here on the podcast, and they're a checkout solution for save now, pay later. So they just, went on the same sort of, pattern essentially. So with Treyd, you essentially get an invoice from your suppliers, which is approved by yourselves, and you pay that invoice for the and then so when do you?
Our customers use us very simply, like they pay their supplier invoices through our platform. So just like they would pay from the bank, but instead they use the limit they have from us, and they can choose to pay it. Okay, I wanna snooze this invoice for 4 months. So Treyd pays my supplier, and I pay Treyd in 4 months. Very simple, but it looks like just paying a supplier invoice. Upload the invoice, add the payment details, select 120 days or whatever number you feel is appropriate, and click pay. So it's from a user perspective, is relatively undramatic.
So you will pay on our behalf. Can we adjust the 4 months to 3 months if we want to pay faster, or 6 months if we want to pay slower?
Yes, maximum 120 days, so maximum 4 months. But 1, 2, 3, 4, you can just choose when you make the payment.
And what kind of interest do they pay on a monthly? I'm guessing it's a monthly interest. Well, I'm not guessing. We use Treyd.
It is. It is, and the interest is set individually per customer, because it's such a wide range from. I mean, we have listed companies with hundreds of millions in revenue, and we have like a year-old just getting started companies with almost no balance sheet and no history. So the range is all the way from like between say 1% and 3% per month to say, but it's a wide range. And what is fortunate for us is the typical experience from the customers. Like it gets more affordable over time, and the limit gets higher over time, because we solve a growth problem. It's like, which is also super fun as an entrepreneur. Of all the problems you can solve, growth problems are really fun because you get this very positive, usually relation with your customer. It's like they're telling us like we have the customers, we just can't buy enough, and you enable the limits, and then they can grow, be even more profitable. We can increase the limit, improve the pricing. So that's the kind of cycle we hope to achieve with and typically do.
Interesting, really, really interesting. And then with regards to the actual invoices from these suppliers, do you have to vet each supplier because you're financing that supplier essentially?
Yeah.
And what's your criteria?
Yeah, so we actually vet every single supplier, and the most important thing from our perspective is from anti-money laundering perspective. We are a regulated business, so and we obviously also want to stay really far away from the kind of bad actors in the world. So not only what do we do, the KYC and quick and easy onboarding, but then for every transaction we do sort of our background check on the supplier. We also have an interesting option that is relevant for some customers, especially if you have a new supplier that you haven't worked with and you're putting a large order. We offer the ability to do a quality inspection in the factory, which you can do directly from the sort of payment interface. Just add a quality inspection, and we'll actually send someone to the factory for like a full day inspection to take pictures, videos, testing your product, etc. And that's usually like $300 or something. And one of the things that a lot of brands really should do more of, it's not, sometimes we require it, but usually we don't, but we actually always recommend it because we've heard so many stories from brands who find a new supplier in, say, China, prepay, 2 months later, open the container and realize that, oh crap, these things don't work, or our customers are getting disappointed and giving bad comments. And that could have been stopped already in the factory for a very small sum. And that would be good for you both, like fewer returns, more happy customers, positive for the brand. So it's not central to what we do, but it is a tool. You don't have to use us for that. You can buy that service, of course, but so that's the highest level of supplier vetting.
Okay, so we don't talk enough about operations and finance in e-commerce in general. It tends to be a back office thing. The more exciting conversations are, brand stories, marketing, sales, but you solve an operational, which is just keeping in stock, and a finance challenge, which revolves around cash conversion cycles and time. Essentially, you're buying yourself time. Do you want to speak to 2 points? One is cash conversion cycles, just that topic of cash conversion cycles, and two, which we'll speak a bit later on, will be essentially around how your data set. We'll get into your data, what you're seeing from like merchant insights, and we'll put that. But let's start out with cash conversion cycles. Do you want to break down why like listeners should be very, very focused on cash conversion cycles?
Yeah, they really should, and I like to think about it and talk about it in like the simplest possible terms, because in practice it's not very complicated. It's like when you're selling, if you're selling D2C, you get paid almost instantly. But if you're selling wholesale, you typically also then wait 1 or 2 months from your customer, right? But D2C typically get paid instantly. But there is a difference between that and when you pay your supplier. And you pay your supplier typically maybe up to 6 months earlier, because when you place an order, pay 30% upfront.
This is for an Asian supply chain, just so we like when you're buying from Far East. Okay,
exactly. And we talk about our customers are like the brands, the product brand type of business. We're not talking about like multi-brand who sells other people's brands, because they typically don't have a big issue of this. They get credit from their supplier and then they get paid instantly. So it's like they don't bind a lot of cash. But if you're a brand, say you're making headphones or makeup or toys or whatever, like you place an order in the factory, pay 30% upfront. So say, pay $10,000 in deposit, and then you wait 45 days, so a month and a half, typically for manufacturing. And then you pay the remaining 70%. So then you pay another $20,000, say, to make the round numbers. Like you pay 30,000, and then you wait for almost 2 months to get the goods in your inventory. That's if you do sea freight, which is cheap and good for the environment and all that. So that's $30,000 that you need to have. And then how fast can you sell this? You won't sell it all the first day it arrives, right? And that is very individual per company. So like how fast you can turn over that inventory. So basically, once it lands in your warehouse, how fast do you move it out the door, right? And this is an optimization that really, really makes a difference, because, and there are a lot of things here, levers to pull to make it better. So like your product mix, how large orders do you place with factories? I mean, ideally you want to put like really small orders for the cash conversion cycles, right? Because then you will sell it as soon as it lands, and the next one comes. Ideally, you get one delivery per day from the factory and send all those products out the same day. It doesn't work like that, because then you're gonna, right? So you want to, for margins, you want to maximize your order sizes, because you will get a lot lower prices from the factory if you place large orders. And the second thing, of course, is the logistics costs, which are a lot smaller if you have, or like the inbound logistics, if you place large orders. So this is something that brands really struggle with. And I think to make this very practical, I think a typical customer of ours, it's like, or any e-commerce brand, they have maybe something like 30% of the revenue that they sort of bind in cash. They need that to have enough inventory to not run out of stock when you're, for your important products, etc. Some are more efficient, some are less efficient, but that's kind of typical. So if you're a, classic like 500K revenue brand, you typically have 150K tied up in inventory one way or another, if we count it all the way from prepaying the supplier. And the practical reality, so you're going from 500K to a million, good 100% growth, which is kind of common of that size if you have something that works. That means you need to go from 150K cash in inventory to 300. So that's another 150K. Where's that going to come from, right? Few brands that are 500K revenue growing 100% will earn 150K at the bottom line, like after everything that they can use to procure. So that is the challenge. And that means like, if you can't find those, you cannot grow 100%. That's right. Like impossible. Perhaps you can improve the cash conversion, but that's going to hurt your margins, right? Because then you have to place smaller orders. You're going to run out of stock. You need to have fewer SKUs. It's like, it's really hard. So that's really where Treyd comes in. Like, you have the customers, you have the growth, but how do you sort of fund that growth? Because the inventory is what's going to stop you. So if you could get like, say, 100K limit from Treyd and use that to pay suppliers, and you might have 50K in profits that you put in, then you can double, like, keep your inventory levels high, which is good for, marketing efficiency. And it also means you can place those, you can continue to place large orders, which means you can get lower and lower cost in your supply chain. You can have low shipping cost. So it's, I know a lot of words and a complicated topic, but also kind of straightforward, right? You need a certain level. And what happens when you go below a certain level of inventory, and the level is different for every business, of course, but there are a couple of things. The most obvious that happens, that's like the standard conversation when a brand finds us, is like, we're out of stock for our most important product. Again, we just wasted all those marketing dollars. It's like, and we don't have enough inventory, and now we have to place an order, and that's going to come in 3 months. So it's like, that's just painful. And companies go into all kinds of tricks and doing, small order sizes and so on, which is super costly, and do air freight. And in air freight, you can get it, instead of waiting 7 weeks, you wait 1 week. But usually super expensive.
my takeaway from what you just said is, cash conversion cycles really is a way to mitigate time. It's a measurement of time. It's kind of like it's a metric used to express like how many days it takes you to convert cash, from inventory to actually selling product. And to me, it's like, how are you optimizing time? Because time, do you want to slow grow, or do you want to seize the opportunity, particularly when you're a small size of 500K and there's a $5 million or $10 million opportunity in front of you over the next 24 months? How quickly can you fund the inventory that your marketing is scaling up front, whether it's retention or whether it's acquisition, to actually really push through and fulfill demand and customer experience, customer satisfaction. And
I think the message is really like, your cash conversion cycle is what's going to determine how fast you can grow in the end. It's like, but the problem with it is like, it's really important not to think about it in isolation, because like, what are the tools to improve your cash conversion cycles? Well, have fewer products, and then you can't do product launches, and that's typically how you grow, right? You need to launch new products. So like, improving the cycle, then it might hurt your growth. The other way is to put small orders frequently. That will improve your cash conversion cycle, but it's really going to hurt your profit. So it's a tough balance to find the right balance. So that's why a lot of brands at least are considering, can we find a way to finance this as well? Because then we can increase growth and increase margin. And that, of course, is magic for a business if you can do both.
Yeah. And you mentioned the fact that you underwrite every single business that works with you, every one of your customers or clients. Do you determine this cash conversion cycle? So with the example that you mentioned, where you're like, okay, they have 150K, a third of revenue in inventory, and they'll need 300K to double. Are these metrics your underwriting system actually looks into and grabs onto and understands to better sort of give a rate?
It does. How it works is like, when you come to us, typically you go through the onboarding where you connect your accounting, so your Xero or QuickBooks, which gives us the data we need. And based on that, we come back with a limit and a price. So this is how much of a limit that you can use to procure, and here's your sort of monthly price. And that is determined by a lot of factors, like how profitable you are, how much inventory you have, etc. That's a bit of the secret sauce in a business like this.
Data science.
And it might not be everything you need, but what typically happens from our customers, they use the service, they can grow a bit, become more profitable, they pay us back, so we see payback on time, and we can give a higher limit and hopefully a better price. And we have this sort of positive spiral where our customers use us to grow and improve, and we can then give them even more so they can grow and improve even more. So that's the sort of what we're trying to achieve, and what is also happening.
Interesting. Really, really interesting. Let's track back to my original question, which was so it was two-pronged. The second bit is really data points, like trends you're seeing. I don't know how many merchants are on Treyd at this point in time, but from a consolidated standpoint, what trends are you seeing? We COVID has occurred, has come and gone. We faced a huge supply chain, challenge over COVID and after COVID. There were freight issues, logistic issues, raw material issues, inflation. And to be honest, we're still in the thick of it if you really think about it in terms of price increases and consumer demand. So what are you seeing in the operational standpoint with all of the data? Obviously, it's all anonymized, so insights are great.
I mean, like you're saying, last year was really a perfect storm. Consumers spent money on other things than buying stuff, and prices remained high in the supply chain. The freight was super expensive. A lot of Nordic customers had had problems with the exchange rate, etc. So that was really, really terrible. And I think a couple of things that we have seen, both in going through that and looking ahead. Like one, there is at least now, I think the horizon is looking again a little bit brighter, because not least on our sort of home turf, the supply chain. So freight rates have gone down by something like 80%. So really getting back to normal. So as you and all the listeners know, it was super painful. It went from like $2,000 to get a container from China to up to $20,000, which was super painful for margins, and we really saw that. The other thing that happened was, of course, also factories where there was so much demand that factories could really increase their prices, and it was hard to get things out. You had to place large orders. But all of that is now improving. So despite the sort of price inflation, factories now again have capacity, and most dramatically, freight prices are really down. They're almost back to pre-COVID levels. And that really helps the margin for our customers. And we saw last year the margins were really getting compressed. We thought that it was going to hurt growth a lot, and we talk a lot to our customers, and people were super worried about like how is Q3, Q4 going to be with this kind of demand. But we actually saw that people remained at reasonable growth levels and had enough demand, but the margins were compressed by the supply chain costs, a little bit also by the spending more on marketing for every customer. But now things are easing up a bit, especially on the supply chain. So we have at least early signs of improving margins again, which is good. And I think at least right now, it looks like a more plannable future than it did last year. Like, who knew what the new demand was going to be after COVID? And now we're sort of through at least one cycle of that. The other thing that we have seen, which might be interesting for some listeners, is we have a mix of our brands. Some are pure direct-to-consumer brands, some are pure wholesale brands, and some are, or the typical is actually you have both. You have both the direct consumer and more of a wholesale side. And this past year has really shown the power of having multiple channels. So we see several of our customers who were, for example, D2C, also adding wholesale channel, because it creates more stable sort of revenue. But it also seems to be, from our data, a more profitable approach, where you can get, a little bit the higher margin from e-commerce and the more predictable, larger volumes, which helps you in the supply chain from having wholesale. And it also seems like the two channels are kind of mutually beneficial to many customers. Like the branding from direct to consumer, you spend typically a lot of effort and time and money on that. Is really helpful for your wholesale channels, and being visible in other sort of multi-brand stores, etc., is also good for your direct-to-consumer experience. So it seems to be a big trend, at least what we see, that you actually mix channels a bit more.
And they're getting, they're getting into the wholesale space, meaning that you need a whole new sorts of skills to actually sell to retail. You need, at least a seller, one head of sales initially, and then you start to build out that team where they'll be responsible for regions or a retailer and all of that stuff. So really, really interesting trend. So is this where the growth is coming from, rather than just sticking to D2C and trying to launch more products? Where would you put your money? Let me put it this way. Peter, where would you put your money in 2023? Would you put it in funding more product launches, or would you sort of figure out, okay, let me go more wholesale and find more of these one-to-many accounts?
Hard one. The entrepreneur always says both, but I actually think
what's a lazier one? What's a low-hanging fruit one?
The low-hanging fruit is probably adding another channel. for your existing sort of product catalog. Because if you spend like all that time, money, and effort into D2C, you have built a strong brand. You have awareness that you can really sell to that wholesale or that retailer or multi-brand store. So I think that's a fairly straightforward way to keep volumes up and margins higher. In general, of course, the gross margin is going to be lower in that, but you get more volume and you don't have to spend the marketing dollars. So I think that's usually the lower hanging fruit.
Yeah, and you get a channel specialist to really, handle that bit of expansion, right?
Yeah, but of course, the other sort of way to do it is also to use like marketplaces like Amazon, for example, is something that we also see. Some of our, even like the wholesalers who haven't done D2C, they often kind of start like that to learn the motion of going closer to straight to customers, but it also goes both ways. But one interesting thing that we see is that usually it's not like exactly the same product catalog. It also opens up for a bit price differentiation. Maybe you sell like not the coolest new design on Amazon. You save that for your e-commerce, your own e-commerce channel. So to keep your margins high, but also get the volume from the marketplace. So
that's an underrated tip you just gave right now. A lot of people don't see, a lot of brands don't see Amazon as a brand discovery platform where people figure out, oh, you exist, this is what you do, let me try your product, and then from there they could either relate with you direct or still with Amazon, or and then limiting that access, limiting that product availability or the scope of products on Amazon is really, really key. So they can find out more on direct with yourselves. Okay, so let's wrap this conversation up. I have a few more questions, which is, how do merchants tend to increase their credit limits on Treyd? I'm asking for a friend.
Yeah. Typically, make sure you have connected your accounting, pay on time, continue to grow, and ideally show profitability. Those are sort of the standard ways of increasing the limit with Treyd.
And then you finance invoices with suppliers, so long as so for every new supplier that comes on board on Treyd, you would sort of vet them, as you earlier said. You do your DD, you do your KYC on them, and then so long as they're within the scope, I assume you then sort of approve that payment, right?
Exactly. And our scope is pretty simple. It's physical products that are non-perishable. So we don't finance like services or fruit or things like that. But for, I think, almost all your listeners, it's the things that you sell. That's the things you should pay with Treyd.
Okay. And then for our CPG listeners, there's some CPG listeners who are, launching the next big food and beverage brand, what have you. Some of them, just alluding to what you said, are really tapping into, they've seen, okay, people love us D2C, people love us on Amazon. We're going to make our first strides by, trying to reach out to the supermarkets to get our products on there. And that in of itself, if you get a purchase order from, say, Sainsbury's here in the UK or Waitrose, where you're talking, sometimes, a purchase order of, we want £250,000, worth of inventory from yourselves. And you're like, how the heck am I going to fund that? Can they come to Treyd for such transactions, or, especially if they're not? Okay. All right. Makes sense.
They can. If it's like fresh produce, like, fruit or flowers or what have you, it's probably not going to work. But we have a lot of food and beverage brands that use Treyd. Okay. It's quite common.
Okay. So another question I have is, within CPG, there are two broad categories in CPG. You have CPG brands that do not do their manufacturing. Essentially, they would use a third party It does not mean that they don't have their unique recipe or unique, blend essentially, but they just don't do it in-house. They do they carry out other functions in-house. And then you have other CPG brands that do everything in-house. And so for them, when they get that purchase order, they're trying to essentially buy raw materials for their, for manufacturing. How does that play out with Treyd?
Yeah, we try to avoid that. Is really not our sort of ICP or ideal customer profile. So we say that to use Treyd, you buy finished goods or almost finished from a factory. So most of our customers are non-manufacturing. So there is always a gray zone. We see, for example, we do a lot of makeup. And usually you buy packaging from one place and you buy the content, the sort of formula from somewhere else. Fine, not a problem. But if you're buying, I don't know, potatoes to make crisps, that should be out of scope.
All right. Okay. Thanks for clarifying. Now, before I let you go, we have what we call a lightning round. So I'm going to ask you 5 or maybe even 7 questions. And if you could use a single sentence to answer each of them, it'd be great. And then we end the show. I give you back your
Sounds
time.
like a challenge. You already heard I use too many words.
All right. Okay. So what advice would you give yourself 5 years ago?
Start earlier. We hadn't started Treyd, and we really should have.
All right. Are you a morning person?
Absolutely.
What's your morning
every day.
Daily? Okay. So what's your daily morning routine?
Yeah, the majority of days is 5:30, and I go exercise in the morning. I think that's the perfect way to start a day, and kind of the only time to find the time. And other than that, then I bring my dog to the office and get at it.
All right. Are you into sports?
I am, although I've now promised our dear investors that I'm not doing extreme sports anymore. But I do manage to squeeze in the occasional kite surfing session, and if I'm really lucky, a ski run.
All right. What's your favorite team, sports team?
The only sort of team sport I watch is actually handball, and I bet most of your listeners don't. I played that a lot when I was young, so I have my favorite team is like my hometown team called Skövde, but that's about it.
Okay, so what 2 things can't you live without?
Coffee, can I say?
We'll send you some coffee. Okay.
Yeah.
What book are you currently reading or listening to?
Yeah, so right now I'm reading a book about Russian history, which is super interesting. I mean, given the world
what period?
So actually, mainly about the more recent years, like from the end of the Soviet Empire and the rise of Putin and all that. So that I find international relations and sort of geopolitics as one of my sort of secret treats for myself.
Interest. It goes back to your cross-border risk analysis and corporate strategy and all of that stuff.
Exactly like that.
Okay, final question. What's been your best mistake to date? By that I mean a setback that's giving you the biggest feedback.
Yeah, I think the obvious one for me is flying into that Norwegian mountain. That is, without it, I would not have founded Treyd or co-founded Treyd. And that is probably the best thing I have done so far.
Serendipity, we say. Okay. Peter Beckman, it's been an absolute pleasure having you on the 2x e-commerce podcast. I would link to Treyd. It's TREYD.io in the show notes. Thank you ever so much.
Thanks a million. Super fun. Finally to be on here, not only listening.
Amazing. Cheers.
Cheers. Bye-bye.